Customers want fast and frictionless digital experiences, yet also expect protection against breaches, privacy violations, and fraud. Drive engagement by optimizing security and convenience to attract and retain customers. Use the PingOne cloud platform to build, test, and optimize digital experiences. The no-code orchestration engine weaves together authentication, user management, and MFA, all of which can enhance security, drive engagement, and boost revenues. Visit securityweekly.com/ping identity to learn more. Managing and protecting the world's grueling number of endpoints, enabling Tanium's customers to see, control, and protect every endpoint everywhere. Tanium's mission is to provide certainty in uncertain times with the industry's only converged endpoint management. Trusted by the U.S. military and the majority of the Fortune 100, Tanium helps manage and protect nearly 30 million endpoints. Tanium, the power of certainty. Visit securityweekly.com/Tanium to learn more.
Welcome back to Enterprise Security Weekly. Follow us on LinkedIn for updates across our organization, show highlights, and more. You can find us by searching for Security Weekly Productions. You can also find me and all the hosts, because pretty much all of us have it linked in our profiles. All right, let's dig into some articles. Adrian was nice enough to pull funding announcements. But before we start, I have to say, so every quarter on Business Security Weekly, I do my security money segment. And I always come to the show notes for this show every quarter to pull all the latest funding information, because I don't think most people realize that like every week you guys cover more funding information than I see anywhere else. And it's a great source to for me to pull all the private kind of funding stuff together. So thank you for all the work that you do every week. It helps me with my other segment.
Yeah, absolutely. I'll take 110% full credit because Adrian's not here to call me a liar. So, no, the reality is Adrian really kicks butt pulling that together. He's got a bunch of great sources. It's kind of neat, Matt, and I would love your thoughts on this. I think more often than not, the individual funding announcements are interesting to talk about, but I think more often than not, it gets really interesting when we start talking about the massive trends, right? Like we're seeing large amounts of funding going into API sec this month, or because I feel like investing in cyber is a herd mentality. Have you seen similar things?
Yeah, because I've been doing this segment for 4 years now, every quarter, you start to see certain trends. You start to extract out some very interesting things. So yes, you'll start to see a whole group of funding announcements around a very specific area because that's the hot trend at the time. I also look at it from what the public market's doing, because I created my own index called the Security Weekly 25 Index, tracks the pure play security companies. And what's been difficult lately is there is so much private equity money coming in and pulling public companies out that it's actually getting harder for me to find companies that fit the profile to replace them in my index, right? Ping, just on last segment, bought by Thoma Bravo. ForgeRock, SailPoint. Thoma Bravo has taken 3 public identity companies out of the market in the last 2 quarters. Like the number of zeros behind that is just, it's amazing. Like that's really interesting to me. Like that's a really interesting trend. What is Thoma Bravo going to take these 3 identity players and what are they going to do with them?
Yeah, and we've talked about this quite a bit on the show, but the KnowBe4 acquisition is another good example of the take private that's occurring there. It's It's one of those situations, I think, where the PE people, normally they'd look at buying a chunk of a company and writing it up or writing it down. And they're looking at the depressed valuations of the public market and going, hey, this is just so stinking low right now that we're just going to literally buy the whole thing and just let it come back up and then re-IPO it. They may not even have to make drastic changes at the leadership level to squeeze blood from the turnip, as they call it. They may not even have to do that. It just could be a market cyclical thing that they're going to cash in on here.
Yeah, I had Robert Herjavec on Monday on Business Security Weekly. It was a great interview because we were talking about the market and what's been going on, and the KnowBe4 acquisition we brought up as well, right? It's hard for these companies to grow at the rates they need in the public market with a depressed market. Valuations have come down. So to your point, PEs come in, pick these companies up. As the market picks back up and spend picks back up, they don't have to make a lot more investment potentially to get a really good return on investment as that market returns. But you're seeing all these dynamics start to play out in the public market. The other thing I've noticed is there's still money coming into these, and there's a good number of funding announcements we're going to go through. But here's what I'm seeing. The dollar amounts are smaller. They're not the big 100 plus, 250 million plus investment rounds. There's definitely been some suppression on the amount of money coming into some of these funding rounds, for sure.
Yeah, and that definitely has been the case. Later the stage, the more the compression. Cs and Ds are really compressed to the point where they're even having trouble finding money at this point. You get earlier, I think the percentage compression might be the same, but the dollar amounts are obviously absolute value much smaller. But it is even starting to hit like some of the seed and A level players, right? Which is where I spend most of my time. And those guys are even sitting on situations where it's like, yeah, you used to be a 20, 25 valuation. Now we're going to give you 12. We're going to give you 10, right? And that seems to be the new norm for even those seed and pre-seed style investments in cyber.
Yeah. And if you look at what's happening, even on the list of companies we have today, the amounts are lower. And so it's definitely a trend. I'll ask both of you, what do you think this signals to the market? Do you think it's just hey, let's wait and see, all financial stuff is cyclical? Do you think we'll see a slowdown in the number of entrants from the vendor side to the market?
No, we won't see a slowdown in entrants. I think we're going to see a continued push for new startups occurring. I think it'll be harder to get funding, but if you've got the right team, the right company, the right market, you'll get the money. It's just going to be smaller amounts, and it's going to be a little bit of a safer investment from the VC itself. They're not going to take the risk of massively overfunding you, knowing that somebody else is going to pick up the bag with a A or a B or a C later on.
Yeah, I think the other thing, so we covered part of this with Robert on Monday. Innovation's still going to happen, Tyler, to your point. Companies are going to come in, valuations are going to be different, funds are going to be different. We're going to see some interesting consolidation, Katie, where you're going to see some of the big players who are sitting on cash be able to scoop up things that they can tuck into their portfolio because valuations have come down. But the one buzzword that came out of the session was EBITDA. You have to show that you can become profitable. It is not growth at any cost anymore. EBITDA and gross margins will play in to how valuations going forward, at least over the next couple of years. He predicts 2 to 3 years, by the way, because he says the final shoe in the market has not dropped, and that's consumer spending. But when it does, that's when we start the kind of the year and a half to 2 year haul out of this. And he said that shoe has not dropped yet. That's why he's still predicting 2 to 3 years of some of this in the market.
What an amazing...
So this is actually good. For one could say this is actually really good for the market because it makes companies be more accountable for what they're building, how many people they're hiring, the viability of the products and services in the market. It's harder because you don't get as many handouts, but if you're going to have a really good product, in a hot market, if it's easier to raise 20 million, maybe you're not as careful about the features you build or the frequency with which you build them. But in a slower market, in a market that's a little depressed, you have to show value as soon as possible, really.
Yeah, what a great interview that must have been, Matt. I didn't have the opportunity to listen to it. I'm going to go back and listen to it for sure because it's right in my area of interest that I spend most of my time researching and looking into. I think, listen, fortunes are made in down markets, right? That's the statement. That's the saying. Cash is king right now. If you're sitting on cash, sit on it. Wait a little bit more, right? And wait until you're confident that we're going to be on an uptick swing. And I think it's somewhere between next summer, next fall, and could be even a little bit longer, right? That's the way I look at it, anywhere from a year to a year and a half, 2 years. But between now and then, I don't think we have much downside left because if you look at the publicly traded cyber companies that are out there, they're on 70, 80, some of them even like I don't remember the exact number for Okta, but it's like 80, 90% compressed from its high. I mean, it's a massive dump. And so, some of these companies are so horribly undervalued. Look at Meta last night. They're down like 18 to 20% today on earnings last night, which puts them at an absolutely basement level pricing. And so, fortunes are made in these environments, and that goes for, investors in the public market, but it also goes for VCs that are now putting money to work in today's economy. It goes for startups and founders that are founding startups at day zero today, right at the bottom of the barrel. The last time we've seen a massive vintage of large return companies came out of the 2008 financial crisis. And so if we fast forward 5 to 10 years, I think we'll see a similar return on startups that are coming out right now in the next 18 months.
Yeah, and that's why you're still seeing funding announcements, right? We're seeing and they're coming from interesting places, right? Like who's making some of these investments? You got funds starting, but there's interesting areas in here, like PII and privacy. I think is going to just continue to take off. So you've got, but this is a $50 million debt financing round, right? Which means they raise money, they need more money, but they can't go raise right now. So let's do some debt financing to give us what we need to continue to move forward. This is the Anonis. I don't even know how you say that one. Anonis.
Anonymous? I don't know. Sounds like a shortened version of anonymous. I don't know.
Yeah, that's what it's supposed to be, I think. Anonis?
Yeah, don't invest in this company. It's a no-no.
Yeah. A no-no. And then you've got people like, so you said Okta, right? There's a lot of, so Okta Ventures, there's a few others that are making really interesting investments. And it's interesting to watch a tech company with their venture funds making investments because it starts to give you a little purview into areas they're thinking about for expansion. So this one, HYCU, do they call it Haiku? A Series B extension from Okta Ventures, but it's going to add into the raise they already have, and this is all about data protection in multi and hybrid IT environment. So, does that give us some purview of where Okta's going? And they moving from identity into some data stuff coming along? Kind of interesting purview.
That seems like a massive stretch if you think of the strategy for Okta. Like, I don't understand how they get one foot into the data security pool. I don't know how that works without them drowning or at least thinking that it's not the correct temperature for them. But you're right. Like, that's exactly typically what these corporate investments are, right? So generally a corporate venture capital looks to put a little bit, and I'm talking a little bit for these guys, $2, $3, $4 million, not a whole lot of money, but to make sure that they're involved in the continued corporate development of a target company that might fit a future strategic direction. And so they'll put in $2, $3, $4, $5 million. They'll monitor them closely. They'll get board minutes. They'll get information that's coming out of the business, so that when the timing is right, they are at the table first to feed when it comes to acquisition. That's what a lot of this stuff really looks like. And, I'm not sure how Haiku, if that's how you pronounce it, fits into Okta's long-term vision. There's also a spot where, listen, CVC, like if you look at the way Dell runs corporate ventures, the Dell corporate venture capital stuff is completely disconnected, isolated, firewalled off from the general Dell business approach. And they invest in stuff that's going to return dollars, right? They're there for the ROI of the dollar. But you're right. In the majority of corporate venture capital approaches, including likely Okta, Cisco, and others that are commonly seen, it's usually a predetermined indicator of where they may make an acquisition in the next 3 to 5 years.
Yeah. Some interesting. Anybody interested in the firewall orchestration space?
What is firewall orchestration? Like, what are we orchestrating? Like, are firewalls even a thing anymore in modern cloud deployment?
This is my point. Like, are firewalls even a thing anymore? Like, we've moved beyond this with the whole pandemic. Like, I just can't. I don't understand this investment. It's a extension of their Series D, firewall orchestration space. Like, guys, firewalls, like, there's nothing to orchestrate anymore. Like zero trust and ZTNA did replace all this stuff. Like
I mean,
Why do you think?
it could be a definition of firewall, right? It could be a definition of firewall in the sense that if we're talking about ACLs or access control lists or cloud-centric VPC definitions of who can get to what, if they're extending the definition of firewall to be a more modernized version of firewall, then maybe. Otherwise, I don't get it.
Why do you think Palo's doing so much with Prisma and Cortex?
Yeah.
What's the I understand firewall, I understand orchestration. I don't understand firewall orchestration.
I'm thinking like Skybox and Tufin, where these solutions were built to manage all the firewall rules across all the different firewalls that an organization would have. I just don't see that being an environment that people need to solve anymore. I don't see it. That's what I read it as.
Yeah. So my guess here is that with the explosion of application native cloud development and APIs in the cloud and the spin up, spin down that occurs on massive numbers of APIs, I believe that API security is going to be one of the biggest markets in the next 5 years. If we believe that's the case, the orchestration of, hey, here's a new API that's being spun up in Kubernetes that has got to access these 4 other APIs or 4 other backend systems for data transfer, right? Because it used to be you shove one app in the cloud. Now it's exploded into 50 or 100 different microservices and micro apps. And I think the automation and orchestration of how those can all communicate in real time as new services are spun up and spun down and what they need to have access to, that's probably what they mean by firewall orchestration. If it's not what they mean by firewall orchestration and that they mean that they can take my 1998 checkpoint box and make it talk to another one, that's a different story.
A turnkey platform.
I think you're right.
Wait, hold on 1 second, Katie. I'll let you get back. Here's a description. A turnkey platform to easily convert your physical firewalls to virtual ones.
Wow. So they are converting my 1998 checkpoint.
It also says automatically deploy, scale, and optimize virtual network firewalls.
Yeah, that's where the value is. That's where it's got to be. And they've got to do it in a dynamic way that's based off of API definitions, based off of microservices or even service mesh-based models. That'd be the only way for it to find value.
Yeah, agreed. Outthink raises $10 million in seed round. They compete directly with Living Security, my new company. They're building a cybersecurity human risk management platform. We've built a human risk management platform, and I know how far $10 million will get you.
Jump to the next
I'm
story.
just going to shoot him down just because it's a competitor to you, Matt. I'm just going to get your back like a good host should do.
I know the amount of work Living Security's put into the platform. I know what we've spent over the last couple of years to get to where we are. There's a lot of work to do. Let me just say that. And you've got a few major players with a huge head start in this market. Now, it is an evolving space. It's a very interesting space. Forrester kind of put it on the map initially, but Gartner is there. I've been doing analyst briefings with the analysts and Gartner's on this. So there is a lot of potential growth in this human risk management environment. I just think there's already an established set of competitors really pushing the envelope. And it's going to be harder for startups with seed funding to get in quickly, I think, because the market's going to move very fast.
So can you help me? Give me 2 to 3 sentences, distill what human risk management means from a fundamental, like we do X, Y, Z, and 1, 2, 3.
Yeah, it's a simple message for me. The goal that everybody really wants in the industry is to change human behavior. That's the stated goal. The problem is you can't change what you can't measure. And the biggest gap in the industry, Tyler, right now is the ability to quantify human risk. What is risky behavior? What are risky activities that users are taking? Because if I can't baseline that, there's no way I can engage them with the right content and the right policies to get them to actually change their behavior. It goes back to the whole concept of safety versus security. Okay.
Gotcha.
And so from our perspective, we start with quantification. So we build a quantification engine so that we can actually quantify human risk. Leverage that data to actually engage the human with the right content. whether it's communications, whether it's training, whether it's policy adjustments. It doesn't really matter. What we want to make sure is that we're engaging them appropriately. A one-size-fits-all security awareness and training program no longer works. Just doesn't. And then what we do is we actually measure the change in behavior. Because we've measured it and baselined it, we can see what these activities are doing, Tyler, to figure out what is actually working and not working, and is it making a positive impact. That's living security in a nutshell.
Got it. And that's, I think Outhink could take some positioning and messaging information from that right there. Sounds like a good message to me.
Yes. Let's see. Any other interesting ones in here that we should talk about? Another seed round, 10 million. Blockchain security, 4.2 million.
I'm surprised.
Crazy.
I'm surprised blockchain security company could get anything right now in the Web3 crush, in the crypto crush. Man, I'm just surprised that even having a blockchain thing at this point is just a difficult thing to raise on. So they got $4.2 million seed round led by IOSG Ventures, and they're a services firm that focuses on blockchain-related audits and penetration tests. That was probably a $42 million investment seed round a year ago. So I'm surprised they could get anything at this point. It's going to be interesting to track. I'm an old pen test guy. I'm an old security guy. And this is an area that I know T-Rob is really, really passionate about and really good at. And this is where I would defer to him on like what it really means to pen test that universe. But is the total addressable market on that one big enough right now, right? Is blockchain going to have enough actual penetration testing needs and requirements in the near future? I'm just not convinced.
Me either. Let's move to acquisitions and failed acquisitions or exits. So Palo Alto, the deal to acquire Apiro falls through. And so they're like, never mind. We'll go buy cybersecurity for $200 million.
That's not fun. That didn't get through either, though, did it? Cider?
Yeah, that's the active one right now. They're in the middle.
Yeah, so that's active. And my latest intel on that one is that one's not going to go through either. What I've heard on the market on that one is that like most, I would say, cybersecurity companies that are in the stage of cider, as far as like their current growth stage, they have an overinflated sense of, I want to say ego, but that's not the right word, but certainly an overinflated sense of valuation of what they really are and what they really mean. And they just haven't course corrected yet. And so I don't think that, from what I've heard from digging in on sources that are in the know on that one, that's not going to go through either, because there are orders of magnitude off on valuation. Maybe not that much, but certainly off quite a bit with regards to the valuation on that particular acquisition. I bet you that one just gets ghosted, as a Halloween reference here, but it ends up ghosting.
Interesting. And that's what happened with the Apiro deal. That's why it fell through. They could not agree on valuation for the purchase.
Here's the reality to founders out there that are watching the show with regards to funding and exit potential. You are not in the driver's seat any longer. You were in the driver's seat up through beginning of this year. You could raise at crazy valuations, and you were raising at crazy valuations. And if you're running out of money now, you're not in the driver's seat. Take 50% off of what you thought you were. That might be able to close going forward. The compression is real. It's trickled down to the private markets from the public markets. If you were 800 before, you're 300 or 400 now. And listen, don't die on the hill because you think you're worth something that you're not, and you're not willing to compromise. Go into these negotiations with a bit of an open mind, because this stuff's not coming back for another couple of years.
Yeah. And Cybereason looking for a buyer because they can't go IPO. I guess they hired JP Morgan Chase to go try to get them sold. I mean, this was a high flyer a year ago, not even a year ago. I mean, earlier this year, they took some money late last year, I think, and then like the floor just fell out of the market, and here they are. Instead of IPO, they're looking to get acquired.
Yeah, I mean, this is a perfect example of what I'm talking about, right? What used to be a potential $5 billion IPO on the public markets. I've heard now rumor mill numbers that are sub 2 for them, right? Taking that much of a squish down, they can't really IPO anymore. And now they're like, well, we can't raise money, right? we're in a spot where it's going to just put us in a weird, awkward position to try to raise on a down round here. We'll just try to get out of it, right? And so they've engaged with a couple of different investment firms and banking firms to try to get them actually sold off. And they're actively out there shopping the business around. You never want to be sold; you want to be bought as a company, right? And they're in the position of being sold. They're trying to figure out who they can sell to, as opposed to saying, "Here's six companies who want to buy us."
Yeah, and we continue to see this trend. Cyber unicorn SNCC to sack 198 employees, 14%. This is after they laid off another 30 a few months ago, back in July or whatever. So you're seeing these very interesting. And I pulled this out of the trends because I noticed you guys started covering these layoffs, and I pulled them into my security money segment. Like, this is a trend. Like, these big companies that have raised big money laying off staff.
Yeah, I can comment specifically about this. So the news article, I believe, is a week old. I didn't look at the actual date on it, but I think it's at least a week old. I think they laid off this week, like the last couple of days. They actually axed about 200. So it actually went through as predicted a week or 2 weeks ago. Put yourself in the shoes of these companies and SNCC's another great example of one that raised a ton of money at massive valuations. And you've given yourself, let's say, 2 years, 3 years, 3.5 years of runway on those raises, okay? And you don't have the revenue to support those valuations. So now you have basically 2 or 3 years, whatever your runway is, to get yourself to that valuation. And so, no, you don't have to look at this and go, we're never going to get there. What they're doing is saying, hey, we have to lay off in order to stretch our runway long enough to reach the valuation that we just raised at last year. And what these are what they're calling zombie companies, right? So we used to be talking every single week, Adrian and Katie and I would talk about unicorns and even decacorns and, all sorts of corns. It's not the situation anymore. Now we're talking about the zombie of the day, the Walking Dead, the one that has a revenue run rate that supports 20% of their current valuation. And they're a race against time to get to that valuation so that they can either raise again or sell the company, or they're just going to continue to walk for 3 years and die. And so, one thing you do is lay off a bunch of people and stretch that runway so that you feel comfortable getting to that valuation in 3 years.
Yeah.
How Halloween of us on this discussion, right, Matt? Like zombies.
Exactly.
No more unicorns. We're going to have Gus put up some zombie icons and some zombie stuff as we talk about zombies every week on the show.
Ooh.
I love it.
So that ties into this next article that Adrian posted. VC take the 13 most promising cybersecurity startups of 2022. Really? Are they? A couple of these I think are interesting, Tyler. Right? The API security vendors, Salt and No Name, because we were talking about API explosion, the need for API security. You've got AppBay, which has been in the cyber insurance side, but we've seen lots of interesting, challenges with cyber insurance. Once you start going down this list a little more, I'm like, how many of these are still high flyers right now?
Yeah, this is a great question. You know what I would like to do is take the 13 most promising cybersecurity startups 2022, see if I can dig out their actual ARRs and their actual valuations and get a multiple number on that today. And you'll real quickly see which ones are actually zombies and which ones are actually growing at a rate that might make it reasonable. I've heard phenomenal things, for example, about the growth rate of No Name. I don't remember the exact numbers. I'd have to look them up. So this is not a quotable number for those out there. But I've heard they've jumped from something like 5 or 7 million of ARR last year to like 30 plus in a year, which is a massive growth rate, right? So they're likely justified in valuations that they're starting to get. I know Salt is growing like crazy. Which one I do love too is super, super young guys, and they have to be careful not to over pull VC money is Tynes. Tynes is doing some amazing stuff on some of the automation side of cyber. R2C is growing like crazy as well. So, I think this list has probably the bulk of younger or even middle-aged or teenaged cybersecurity companies with massive growth rates over time. And it's a question right now. I love it, Gus. I love that. Thank you. Talking zombies. I think the question right now is, can they maintain that growth rate so that it doesn't fall flat and that they turn into the zombies of the day?
Right. Yeah, and that's why I said the new buzzword in cybersecurity, EBITDA. It's EBITDA.
Earnings.
You guys can talk about XDR and zero trust, but at the end of the day, what investors are looking for is EBITDA.
Yeah, I agree. Definitely, certainly in the later the stages, the more EBITDA margin focused, cash focused that they're going to be. When you're still in the early stage, you can kind of get away with it a little bit more. But it's funny, there is one company that I won't name that I advise that I'm an investor in actually, and I had a conversation with the founder the other day, and he's very adverse to a super high growth, mega high growth. He wants to grow at a healthy rate with a healthy pace for the company, which fits very well for today's investors. But I think there's a fine line, and this is a difficult thing for founders to figure out. There's a fine line on how much you turn that volume up. Traditionally, we've always turned it to 11 and said, grow at all costs. It doesn't matter. You're either going to turn into a unicorn or you're going to die trying. That's no longer reality. But at the same time, you can't just leave it on one and go, oh, I'm just going to be a safe player and I will be profitable from day one, because you leave so much growth potential and value for your business on the table that there's got to be somewhere 4 or 5. I don't know what the number is. And I had a conversation with this founder and was like, look, man, it's time for you to turn it up, right? Your traction's there. All your proof points, your product market fit is there. Turn it up a little bit. I'm not telling them to burn at all costs, but I am telling them, hey, put a little gasoline on this fire and let's get moving here, right? So, I think it's just a fine line, and I think we'll see over the next few years that comes and goes depending on the stage of the business that you're in and what your competition is doing too. That you have to kind of watch that. If your competition is lighting money on fire, you can try to play the same game and outpace them, high risk. Or you can just say, we're going to take a slow growth approach here and let them flame out, let them define the market, and then we'll catch what's left. And that works too. I think it's a lot of strategy you need to consider as a CEO that up until last year or up until the beginning of this year, you didn't even have to think about, because the answer was always go as fast as you can.
Right. Yeah, I agree with you. It's interesting conversations because, as you know, I advise a number of companies as well. Plus, I'm in a startup, right? And this is, I can't build things fast enough. Right. And we want to go faster because we've got this great market opportunity in front of us. But you also have to make sure you got enough cash to do it, because the faster you burn cash, the more quickly you have to raise. And if the raise environment's not right, you're not going to get the valuation you want. So it is a very interesting balance, Tyler, that startups have to go through at this phase, especially in this type of market.
Yeah, and it'll come and go. It'll come and go too, right? You're going to go through, I describe it as accordion. Like, I feel like a startup is largely an accordion, right? Where you get going and you stretch and you just, you squeeze it in and you press hard and you burn fast. But then you got to remember that there's the other side of that accordion. You got to stretch it back out. You got to let the music come out. You got to absorb what you have. And I think there's times for a startup to really go hard. And then there's times for them to stay flat, maybe pay down some tech debt, maybe make sure that their customer success plans work as originally intended, that they have true product market fit, whatever those situations are. And then once you get that all on lockdown again and you feel comfortable and you feel good, you can burn hard again, right? So I think it's a waxing and waning kind of approach that will eventually win. Because if you overcorrect and just say, I'm just going to go slow, you'll never get there. And if you overcorrect and burn too fast, you're going to flame out and you'll never get the next round of investment, because they're looking at things like EBITDA and margin. And I think that's just it's something you're going to have to watch as a founder and play that accordion.
Yeah. Katie, where do you want to go? We've been monopolizing like all this funding talk.
That's okay. I always learn something on every show about investing, because I'm just a working stiff here. So
you can learn how to play the accordion, Katie.
I probably could figure it out. I had to play the piano to get through college. So
for those that don't know, Katie has a music degree. I bet you she could play the accordion.
I have a bunch of useless music degrees. How about nudge security? That should interest you too, Tyler, because Adrian's take was that this is something new and different, and where's the market fit? I think we could already say that there is a market here for SaaS app identity. I'm pretty confident that I would say that.
I'm pretty sure Tyler would too.
Yeah, I was briefed by Nudge already. I like the guys; they're good.
I
They're
mean,
really cool. It it's a common market. They're doing it a little differently, and I don't want to get into their secret sauce. I'll let them do that. But suffice it to say that SSPM, which is a market, and I'm surprised in the show notes, Adrian says, I'm sure Gartner is working on an acronym for this. They already have one. It's SSPM, SaaS Security Posture Management. They're doing it in different ways, right? Like there's some companies that will look at your data going in and out of your environment and automate and detect what SaaS services you're using that way. There's others that even connect to your email system and look at what what SaaS services are being emailed to your user base for like login credentials and things, and identify them that way. There's lots of different ways that you can identify the SaaS services in use. And then connecting to those ones that are in use over APIs and securing them and making sure they're configured properly. It's a market that's not old, but it's certainly not like, hey, this is the first time I heard about it last week. But I think Nudge is taking a unique approach to it. I'd advise folks that are listening, if they're into that and they need that kind of service, go directly to Nudge to understand the how they do it, because it is unique and different than most. Plus, the guys are super cool. Really like the founders. I think it's a pretty cool company.
Yeah, it's a good market. It's an important market. If you look at the problems that we're having with unmanaged apps, the problems we're having with shadow IT, the problems with user data, customer data, employee data going into apps that IT doesn't know about, you need something to find these apps. So their approach does look different, the approach, but the overall message and the overall functionality it's a hot market. I can tell you, we're looking at new entrants every day, like literally every day there's somebody else that pops up on our radar.
Yeah, I definitely agree, and I love the space. I think it's a very hot space, specifically because SaaS services are growing. They're not going away, and I think more and more people are going to be using SaaS services to how they run their businesses. We switched to the infrastructure in the cloud, which is where Amazon really excelled. And now we're switching to everything being SaaSified, right? And I can go on and on for what that means to all sorts of different cyber components and cybersecurity related companies. But no, it's not a new market. And quite frankly, from an investment standpoint, I really like these guys because they're doing it differently. It gives them the ability to have differentiation in market, but it's a market that's very clearly well defined from a value proposition, what you do. You just have to do it better than anybody else in the market to dominate the space. And so, as far as SSPM goes, look at the how they do it and see which ones make the most sense for you as a business. That's where you need to buy.
The only thing I would ask, and I just don't know enough about this company, but if they're monitoring Google Workspace and M365, what about custom built apps? What about apps that aren't on those marketplaces? How do they detect those? How do they find those?
Because that's marketplaces. They're looking at the authentication system itself. So if you use Office 365 to authenticate to a SaaS service, they can detect that authentication occurs. That's where they're getting their data from. Like I said, I think it would be really cool technology, and they might be doing this eventually. I don't want to ruin their futures, but I think the best SSPM vendor looks at the authentications occurring in your Gmail, in your Google, or looking at your Office 365. I think they also look at authentication and sign up emails within the email systems of the enterprise. I think they look at data too. They look at data in transit on the network where they can capture it and see additional angles into what SaaS service is being used by your endpoints, right? Somebody that rolls all three of those together and can actually catch everything is going to be in really good shape. Now, each of them will defend their way of doing it, right? They'll say this way's the best and here's why. But if you could do all three, that'd be pretty powerful.
Yeah. Ties into these next couple articles, which I thought were interesting. The company behind Hey.com and Basecamp vocally ditches AWS and GCP. They're like, yeah, too expensive for us. We're going back to on-prem. There was a number in the article. They spend something like $500,000 a year for RDS, and they're like, "Look, we can run our own database for less than that." Interesting, because as you just said, everybody's SaaSifying, right? But are they?
So this is interesting because I just wrote an article on this. I saw this a couple of days ago, and I wrote something that's coming out. So I might change some of the things I say based on our conversations and your input here. But it's an interesting conundrum because you have this, everything is SaaSified for sure. And more companies are going to the cloud, just like we have with our last guest talking about, it's just easier and it's faster for a lot of companies. But if you get to a certain size and scale, then yeah, you just have to look at that ROI. I don't think this is the wave of the future. I just don't. Because I don't think a lot of companies have the time or the inclination to build out these teams. But on the other hand, if they do, you do have to look. You can't just adopt something because everybody else is adopting it. That herd mentality is prevalent in security, but it's not always the right approach because you really have to look at your own environment, your own capabilities, your staffing budget, your skills capabilities. We've got a staffing problem as well. So it's not just like, okay, hire the people and you're good to go. That's not the case, and it's not going to be the case for a long time. But if you are spending as much time maintaining somebody else's environment where, I understand they could be a single point of failure, and to our last guest point, yep, they have the teams there in place, ready, on call and waiting, whereas another company might not. But once you get to a certain size, you're a leader in the market, you've got the skills, you have to make that determination, even if it's not what the Gartners and the Forresters of the world are saying. Everybody's moving to the cloud adoption up 98%, or, obviously I made that number up. But we have seen, since the start of the pandemic, even more companies using public cloud because they had to. But now we're getting to a point where we're going to start to see baselines because the pandemic isn't necessarily over. I don't want to get into controversies and politics and all that garbage. But the fact of the matter is we're reaching a point with our workforce where it's reaching a place of stability in its instability. So the baselines are starting to come back again. And that's what we have to be looking at as companies. And we have to be looking at our balance sheets and saying, what do we use? How do we use it? Now we have some stability now. So what do we use? How do we use it? How can we manage it? Because moving more to the cloud is not going to be for everybody.
Yeah.
But then again, I don't see most companies pulling out like they did.
What a great article. Like, I totally agree with you. What a fantastic article, because I don't think what Hay did is the easy button, right? The easy button is just leave it in there, get more money and burn harder. And right. I think what we will see here is, well, there's a couple things. There's the fluctuations of a business of scale that make it difficult at that middle stage. When you're little, the fluctuations aren't that painful. When you get to that middle stage, if you ramp on a bunch of users and run them through the roof fast and do big marketing pushes, those fluctuations, you have to plan your capacity for the fluctuations, and that gets expensive. And that's one of the reasons why that middle stage is kind of a difficult situation there, right? The other question is, it's not just about, hey, we're going to put bare metal in our data center. A lot of companies don't even have data centers. They got to build data centers. They got to hire a bunch of people. I think there's a whole lot of math behind this that would have to be done on a project by project basis to determine whether it's financially viable to bring it back in-house from your cloud deployments when you reach that mid stage, or whether you're better off plowing through it and saying, hey, we're good enough. We're going to plow through it and get to the large stage. And then when you're at the large stage, you've got the capabilities and weight to go, hey, we're paying you $10 million a year. We're going to negotiate that down to a flat 6. We can spike to these things. Like, you get a lot more negotiation power when you get bigger. And that's why that difficult middle stage is a bit of a squeeze. So, I think at the end of the day, it's not a cut and dry, we're going to see a mass exodus. I don't think it's cut and dry, we're going to see massive growth either. And here's my prediction on this one, is that the market will correct. And the market being Amazon, Google, and Azure, they will correct for this problem eventually. And it could be the funding downturn and the macroeconomic downturn that causes them to correct, because companies like Hay are going, I can't afford this anymore at that middle level. So I'm going to pull out. I'm going to find a way to do it a different way. And they're going to have to adjust their prices. They're going to have to adjust their scale capabilities. They're going to have to find their packaging in a different way. A lot of different ways they can fix it. But I think the market, I'm a firm believer in capital markets in general. I think the market will sort itself out as those mid-tier players start going, hey, this is too painful.
And I don't think this is uncommon. I mean, the cloud actually has been around for a really, really long time. We just think of it as the cloud for the last 20 or so years. But, in any product market where the product is really, really, really hot, right? Like you see it every Christmas season with kids' toys. That hockey stick growth. Everybody's clamoring for the toy. People will pay whatever it takes for the toy. After a couple of years, that toy, the kids don't want the toy anymore. They bring the price down. They make it more accessible. They do some tweaks and some changes so that the company doesn't die off, or they just create new services. We're not talking apples to apples here with the toy market and the cloud market, but I think the same premise holds, is that for the past 20 years, first we took a while for people to get comfortable with the idea of cloud. Then people were like, yeah, cloud's pretty good, not going to move everything. Then we started moving to hybrid cloud for the single point of failure reasons. Then it was, oh my God, we must go to cloud because this is the easiest thing to do in a really terrible situation. And now it's, okay, we've got pretty mass adoption of cloud. What do we do next? And I just think the real key here is individuality and not following the herd on this, because I don't think just because an analyst firm or just because, three Yahoos talking on a podcast have an opinion, that's what is right for your business. I think it's very much a financial calculation, like you said. And I think it's really important for companies to remember that they don't have to do what is in those analyst reports or what the analyst data says if it doesn't make sense, because this isn't one of those things like, if you don't secure your APIs, you're screwed. That's not the same calculation.
Yeah, Katie, just so you know, we're not three Yahoos on a podcast. We're two Yahoos and Katie. So let's make sure we get that straight.
Yes, I resemble the Yahoo remark. I'm fully comfortable with it too.
All right, Rain token.
Exchange server, anybody? Not secure? Like,
surprise.
Surprised? No, not really.
Hey, 1999 called. They want their news back, Matt.
That's a your old when joke.
Yeah,
the beard is coming quite gray over the years, Katie, I must say.
Yes. There's a couple of quick trends. This whole Gen Z and millennials less serious about cybersecurity on work issued devices than personal. Is anybody surprised by this? Like the whole Gen Z millennial poll, they're just different. Like, did we expect them to be the same?
Hey, you better be careful now. You're going to sound like the old curmudgeon here. You keep that up.
I am the old curmudgeon.
I don't know, man. So I'm part of a Gen Z investors, and I don't know, they should have never invited me to it, but I'm part of a Gen Z investors Slack where it's all Gen Z related angel through like full on VC investors are in there, and there's a lot of them in there. It's a massive community, and I don't think they're any different than we are. I just think fundamentally, they've gotten to the point where they just tolerate it less. Like when we were younger and we were coming up, people would say, oh, you need a password that's 30 characters long, 17 special characters, 37 underscores, whatever it is, right? And we just had to do it, and you kind of just did it because it was the right thing to do. They tolerate it less now. They're like, hey, I don't have to do that. I'm not going to do that. Give me a better technology to do that, right? And they have better technologies. They have fingerprints, biometrics. They have two-factor auth, SMS-based two-factor auth. They have all sorts of different ways, Authy apps, whatever, you name it. And so I wouldn't necessarily say that they're less serious about cybersecurity. I just think that they expect a higher quality, and they don't tolerate the garbage that we've had to tolerate earlier on in our careers.
Yeah, because they grew up with these things, right? These phone thingies that we grew up with.
Yeah,
like it's so much easier now. And to go back to a MacBook or a ThinkPad or whatever and have to deal with all the craziness that you have to do over there when it was so easy over here is, I think, where this really gets interesting. And that's why there's kind of that disconnect, I think. Because we grew up on the computers. Like, when did you have your first portable device? Like, when did you have your first notebook, laptop kind of PC? Like, everything was wired together. It was at a desk. We never carried these suckers around. Like, I can't even remember my first one. It was had to be like 06, 07
Oh
maybe.
gosh, no, it was well before that, and it was about the size of a toolbox that was a luggable, right? That had a handle on the top of it, right? That was the original laptops, were these kind of like not even lunchbox, but literally like toolbox size, where you opened it up and there was a monitor built into a huge computer the size of a typical contractor's toolbox. Man, it's just a different world now, and I don't think that they care less. I actually think that they care more. They want it. They want privacy. They want security. They care about it. They just expect it to be delivered to them in a non-intrusive, user-friendly, great user experience kind of way. And they're not going to tolerate. If you're going to give it to them any other way, they're not going to use the technology. They just don't. And I mean, at the end of the day, right, this article is specifically about that they're less serious about cybersecurity on work-issued devices than personal, that they care more about their personal data than their work data. And of course, that makes sense, right? Because their work data they're young, they're not invested in the careers as much as older folks like we are too. And they're like, hey, I don't want it to be compromised, but if work's going to put me through 37 hurdles, I'm just going to get around it because I don't, it's just not the right way to do it. So I think it's just about making sure that they're given a great user experience. That's the only way you get Gen Z to actually come along.
And I think there's another issue that is riding sidecar to what you're saying, Tyler, and that is not only do they expect better security because they've grown up with computers, it's been in their lives, but it's not necessarily, I'm not going to get into the semantics of millennials and Gen Z care less about cybersecurity on work-issued devices, but they also live in a world where people change jobs every couple of years, whereas a lot of us started our careers and still know people our age or a little older who have been in jobs for 20 years, 30 years. That's not how work is anymore. I remember having a conversation with my mother years ago. She was like, you have so many jobs. Your father's had one job. Your brother-in-law's had one job. I'm like, that's not technology. And that's not the world today. That's not how it's going. People change jobs. And it's not necessarily a bad thing. It's not necessarily a knock on you as a worker. It's just a different world. And so if something is temporary, you're going to be less invested in it than if you think, oh my God, I'm going to be here and get that gold watch at the end of my 30 years. By the way, I don't think anybody would be impressed with gold watch anymore, but
I would.
Okay, all right. Whatever. But the idea that, oh my God, I have to be super, super careful about my work stuff because I'm going to be here for 2 years. Well, no, that's somebody else's job to make sure that that thing is secure and you're going to be leaving anyway. And also, I think when a lot of us started our careers, because there was that worry about having a job and being in a job for a long period and being seen as less successful if you can't move up through the company over 10, 20, 30 years, we were less prone to say things. And those of us who have bigger mouths have gotten in trouble over the years when we've pushed back on policies. That's not how these generations were raised. They weren't raised to sit back and look pretty. They were raised to voice their opinions. And so you've got people who are a little older in companies hearing this thinking, oh my God, these people don't care. That's not it. They're just raising their concerns or they're raising their dissatisfaction or whatever the case may be. And that's being taken negatively, but it's not necessarily. Maybe it's just making people think in a different way.
Are you sure you're not a Gen Z or a millennial deep inside there, Katie? I would think you might.
These reading glasses actually give me away.
Adrian's got some great free tools listed in here. There's a couple other great articles, but I do, unfortunately, I want to wrap it up so I don't feel like I left you guys here forever, because we're almost an hour into this segment.
We could talk for days. We could talk
I know.
for days.
I know, and we should. But I want to thank you so much, Tyler and Katie, for joining me today. It was a pleasure to get to host the show with both of you.
Absolutely. Thank you again.
And a big thanks to everyone for watching and listening this week's episode of Enterprise Security Weekly. Adrian's back next week. Adrian, the crew, will see you next week.